Good afternoon, everyone, and welcome back to Week in Markets. More of a UK focus this week. Delighted to be joined by Sebastian Mackay, Investment Director on the investment team. Seb, let's get straight into it. But first of all, we're not going to start with the UK. We'll cover off an important data point, which was US inflation. Important because it was for the month of May, and it was expected to be the first measure which showed the initial impact from tariffs, inflation and goods prices, for example. But that wasn't the case, Seb.
So a pleasant surprise in that the increase on the month was only 0.1%, so slightly less than a consensus of economists had expected, and not really showing evidence of companies passing on higher tariff costs yet. I should say that it is still pretty early days, and we could see an impact in coming months from the tariffs. So we're probably not out of the woods yet, but the early signs are good.
And with an eye on the next meeting of the FOMC, the US Federal Reserve Monetary Policy Committee in 2 weeks, do we think this in any way informs them?
I know President Trump would love them to slash interest rates at the next meeting, but I think probably the FOMC will conclude that it's just a bit too early. So things like services inflation is still quite sticky at just over 3.5%, and so the evidence that there's still kind of latent stickiness within inflation from even before the whole tariffs debacle. The evidence is still that inflation is a little bit sticky.
So inflation's sticky above 2% on most measures. It was a very soft print, wasn't it? So the month-on-month number was just 0.1. So I guess 2 or 3 more of those would perhaps allow the Fed to conclude that we are actually in a wave of disinflation, and perhaps they could signal that future interest rate cuts can be brought forward to the back end of this year.
I think it's coming, but it's maybe not the next meeting.
Right, that's enough for the US for this week. Let's focus in on the real meat on the bones, which is the UK. So 2 big data points this week and the spending review. Employment data on Tuesday, and then we had GDP Thursday. Up to you to wrap it around the spending review, but takeaways from the economic data first.
The economic data has been pretty weak overall. So the labour market data, as we all know, is that the national statistics are having difficulty with collecting the data at the moment. So the response rate for the survey is just incredibly low. So the official labour market data have to be taken with a pinch of salt. But we also get data from HMRC, which shows payrolls as well. And that was very weak. And then on top of that, this morning we had the first the release of GDP data for the month of April, which showed a contraction of 0.3%. So, and we were all expecting something to happen in April, because we know that was April was the month when the increase in employers' national insurance contributions came through, and other kind of increases in energy costs and so on. So maybe it wasn't a surprise that the number was quite weak in April, and we had seen some quite strong data, monthly GDP data, prior to April. So maybe this was just a bit of a payback.
And it was probably the first month which did have some tariffs impact in terms of the export of goods.
Yeah.
Although services was very weak, which may just be more of a seasonal adjustment in the GDP data. So just on the employment data, you mentioned there are 2 surveys or 2 measures there. There's the survey data, there's the HMRC payrolls. It's the payrolls data which appears to align more with other survey-based measures, where the Bank of England do go out to regional agents and speak to businesses direct. So it does appear the jobs market is slowing.
Yeah, and what's quite interesting is that at the time of the budget back in October last year, it was initially characterised by the OBR and the Bank of England as well as being expansionary, but the evidence, they've since revised that characterisation and now concluded that it's actually contractionary, and the evidence from the economic data does suggest that the budget measures are constraining economic growth.
And of course the Bank of England have cut rates in late winter and the spring, so they've certainly pivoted on that view. And at the margins, some modest cooling in nominal wage growth across a number of sectors. But so that's probably key for the Bank of England to perhaps signal again that they can cut rates at the back half of the year?
Yeah, I mean, most of the measures showed wage growth at just over 5%. I think something more akin to 4.5% would probably make the MPC start to relax about potential inflationary pressures from the labour market.
And of course, we also have a Monetary Policy Committee meeting from the Bank of England this month.
Yeah.
Perhaps like the Fed, we're not expecting any change in interest rates.
No, but expectations of subsequent cuts or subsequent meetings are for rates to be cut further in the UK, and those expectations have gathered pace as a result of that weak data that we've seen.
So obviously on the TVs we've had Chancellor Reeves trying to perhaps talk down the weak job growth numbers, the surprise there, also the weak GDP data as well. Let's wrap it round to finish off in the spending review. What can we take from the projections of spending from government?
It's the money's run out, basically. Times are tough. They did manage to secure a 3% increase for the NHS, but that's really at the expense of pretty much all other departments. And so the UK is just in this really difficult bind where the fiscal rules mean that there isn't a lot of money to go around. Economic growth is weak, which means tax receipts are weak, and it seems like we're in this kind of vicious circle. I suppose the thing that would kind of break that vicious circle would be if we were to see disinflationary pressures gathering, and that would allow the Bank of England to cut interest rates quite aggressively, which, you know, in the context of lower inflation, would probably lower gilt yields, which would lower the government's cost of servicing debt.
But of course, all that doom and gloom for the UK, and yet the stock market reached a new high this week, the FTSE 100. Yeah. We've also had lower bond yields. We've had a positive return from the gilt market, and we saw, for instance, equity markets in the US get back to where they were on Inauguration Day, and that was really before Trump started to talk about tariffs. So markets able to look through some of the gloom for the moment. So that's all for this week. It was just to focus in on the UK, given the unusual clustering of data we had, as well as the political event in the spending review. Please do join us next week for a Morning Markets, where we'll take more of a focus on UK inflation. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.